Good morning and welcome to another live technical analysis. We're going to be starting off with the euro against the dollar. As most of you probably know, the PMI figures have already been released approximately about an hour and a bit ago, around 10:30 for the UK. So what we saw from the PMI, the preliminary PMI figures, was that Germany's manufacturing industry was better than expected, services as well. What was interesting was France's preliminary PMI figures. Those came in lower than expected, which may be concerning for the French economy. But given the size of Germany's economy, it appears that it has slightly outweighed the excuse me. It appears that it has outweighed the it has outweighed France's lower than expected PMI figures. It appears that I'm having an issue with the mouse today. You'll excuse me for a moment. Appears that it has glitched. Until we fix the mouse, what I can tell you is that the PMI figures, lower than expected for Germany, better than expected for Germany, appear to have supported slightly the euro on the release, but France's lower than expected PMI figures may be concerning over the long run. The issue is that if one of the two, so for in this instance, France, lower than expected, may be concerning when it comes to the ECB in deciding their interest rates. So ECB Vice President de Guindos also hinted that they may be nearing their terminal rate, but have not reached it at this point in time. And as such, it may be the fact that they may have some way to go. So that could potentially provide support for the euro in the long run. For now, it appears that the euro has reacted slightly positive. The 4-hour candle might be slightly bearish, so it may have been that they've balanced each other out. For the UK, the PMI figures also came in better than expected. Chancellor of the Exchequer Hunt yesterday released the UK's essentially their plan for the next few years. They're cutting approximately 2% of contributions, which may stimulate some economic growth. But from a more macro perspective, it does feel like the UK economy may be moving towards a recession. So the figure was started, if I'm not mistaken, at 0.3% of GDP growth in 2028 and 2029. 0.3, in my opinion, is fairly low. So you're trying to stimulate the economy for a 0.3% increase in growth. It seems that there might be some more to it. I think that the UK economy may be having some issues. But the PMI figures appear to be proving me wrong, as once we're able to show you, it appears that the British pound has reacted positively, so the better than expected PMI figures may be supporting the British pound. Excuse me, we need to fix this mouse, as I currently cannot. Oh, there we go. Never mind. So for the euro, let's remove our support and resistance levels, and we'll place them again. So as we've said, for the euro, Germany's PMI figures better than expected. So I'd place support at 1.08. So you know these are the Bollinger Bands. 1.0875 for R1. For S1. Let's switch this to green. So are we taking this point? Is this swing low? And then we're seeing touches at this previous high. Actually, just slightly higher might be more prudent. And as you can see, as I've said time and time again, I prefer the closing and opening figures rather than the wicks, although wicks can be used to confirm. So slightly higher is 1.087, excuse me, 1.0880. That would be S1 for me, 1.0880. S1. Now for S2, simply placing support level at S2 here, as you can tell by yourselves, it's too close to S1. So we're going from a more macro perspective. We can take this previous high, which formed this ascending triangle. So 1.0745, also previous high. Potential for support at that point in time. 1.0745, so that would be S2. And then for S3, perhaps you could go slightly lower. We're ignoring this support level and we're going slightly lower as it would be far too close to S2. And since we're looking at this from a more macro perspective, we're going to be giving some distance in between our support and resistance levels, 1.6020. And then for our resistance levels, R1, turn this to red, 1.0955. So this would be my R1. So as we said, perhaps the two PMI, the preliminary PMI figures for France and Germany may be countering each other. So some slight support upon the release, but then France's PMI figures may be mitigating any potential gains from the better than expected PMI figures, preliminary PMI figures for Germany. Let's just finish off with our resistance at R2. Taking this point here, let's just zoom in. Actually, it might need to be slightly higher. This is why I prefer opening and closing figures validated by this wick. And as you can see, this could have been a prior support turned resistance level. So this is R2, 1.1040. So 1040 for R2. And then for R3, this previous high found resistance, wicked slightly higher, took out and gained liquidity and moved lower, validated as resistance for R3. And 1.113, we could see 1140. And let's just go back and make sure that it is actually touching on the bullish and bearish candles. It is not. This is why you always go back and check. So it's 1.1135, so 1137, 38 for R3. So 1138 for resistance level of R3. And now simply placing our text labels, make our chart look slightly nicer, easier for the eyes to see. It's broken below our upwards moving trend line, so you could maintain a sideways bias. RSI is still near 50, but given that it's 60, it may be the beginning of a bullish market sentiment. But the Bollinger Bands have narrowed. They're between, if not on R1 and S1, perhaps slightly below S1, slightly above R1, but they've narrowed. So low market volatility, mid-range. Would not be surprised if it moves between S1 and R1 for the rest of the day. For a bullish outlook, simply breaking above R1 would suffice. For a bearish outlook, simply breaking below S1 and moving lower than this point, 1.8365. I'm not placing this as a support level, as I think this may be a more predominant support level from a more macro perspective. This might be a temporary support level, but based on how we're structuring our support and resistance levels, S1, 1.0880, or 1.0955. For now, sideways bias. RSI, if it turns down to 50, would validate perhaps a sideways bias, narrowing of the Bollinger Bands between S1 and R1, for validating it. And the conflicting PMI figures of France and Germany seem to also be supporting that the pair may move in a sideways fashion. Today is Thanksgiving in the United States of America. As such, financial release from the US we will not have today. So the dollar may be ceding control to other pairs. So as we said for the British pound, if we go into a 30-minute chart, this was the release of the preliminary PMI figures, 61 pip move, 47. It was at 10:30. Let's go to the 1-minute chart. So this was the release, 10:30. Yes. Yep, 62 pips, give or take one. Moved higher. Bullish outlook for the British pound against the US dollar. Support, two options. One, this point here, but you're neglecting these two candles. It could be indeed a support level, but bigger candles. I think this may be more of a support level, also coinciding with the lower end of the Bollinger Bands. So another reason as to why it may be support. So that's 1.2470. And then we could keep RS2, 1.2325. And then support and resistance levels, perhaps we could bring R3 slightly closer to R2. And then for S3, slightly higher. Failed to break below, and then continued moving higher. So 1.210 for S3. And then we'd need to find R3. RSI near 70. Perhaps a bullish outlook for the British pound, but it needs to break above R1. It's narrowed, so it implies low market volatility, and we could actually find a closer resistance level. $1.2575 for R1. Note how it's coinciding with these candles here. Came back, failed to break below. When it managed to, support and resistance, validated by this price action here. So this is R1. Then R2 we're keeping the same, and we said we would bring R3 slightly lower. Previous high here, broke above, resistance and support, broke below, validated here. Support and resistance. So 1.2994, 2.995. So this is for cable, if you want to use the lingo, British pound against the US dollar. So for a bullish outlook, simply breaking above R1, aiming for R2, which is slightly further away, too far away, which means we need to readjust R2 as well. Taking this previous high, came back down, moved lower. And then this actually might mean that we do need to bring R3 lower. I'm going to keep R3 where it was. I think it's a significant resistance level, but we're going to be adjusting R2 as we did. 1.2750. Bullish outlook for the pair. based on the preliminary PMI figures. Though from a more macro perspective, I still maintain the view that the UK economy may be entering a recession. So take that as you will. 1.2100 for S3. Moving on, we can look at oil. So oil, OPEC Plus has delayed its meeting from this weekend to November the 30th. And the reasoning behind that, as is being reported by various news outlets, in particular Bloomberg, CNBC, and Reuters, is that there have been disagreements in regards to oil production cuts. So if there's a disagreement, that means, and what I'm guessing is Saudi Arabia probably wants to extend the current or even increase oil production cuts into the future. Whereas I'm assuming now that they may be getting some pushback from other oil producing nations, in particular the United Arab Emirates, who would like to increase production. Further rate cuts for them could potentially reduce potential profits. Whereas for Saudi, because it's easier for them to control their exports, the amount they produce, it's easier. They may be more willing to cut production in order to drive prices higher, which does not seem favorable for other oil producing nations. So you're having perhaps a rift in between the OPEC plus nations, which is why we have seen this bearish candle moving lower, touching support 74.35, R1 77.25, and then you have R2 80.10, R3 83.15. In addition, the EIA crude oil inventories came out yesterday, 8.3 approximately 8.3 million barrels, which was higher than the expected figure of between 1.1 to 2 million barrels, implying perhaps a reduction in demand for oil in the United States of America. So prices driven lower, market correction. Sideways between S1 and R1, although fairly tight still. Perhaps for today between 74.35 and 77.25. For a bullish outlook, simply breaking above R1 and actually moving towards R2. So not simply coming to, if the commodity comes at 78.53, which is coinciding with the upper range of the Bollinger Bands as well, it would not be sufficient for a bullish outlook. It would need to break above this level as well for a bullish outlook for me to occur. For a bearish outlook, simply breaking below S1, sideways between S1 and R1. If it fails to break above this level, we're most likely the next time I'm going to switch and bring resistance up to this point. But for now, this appears to be a strong resistance level. RSI 50, 47.56.6. So sideways between S1 and R1 up until one of these is broken. We actually need to place support for S3. And let's see. Place that where the upward moving trend lines began. 67.35. So you have S3, S2, and S1. S2 is not at this point. Why? Too close to S1. Why is S1 here and not here? It found support. You can see there was a strong downwards move, which was then reversed. So it looks like there is support at this point, which is why this is S1 and this is S2. For R1, start of a strong move downwards. So sell orders around here. Resistance at 77.25. We will be looking at the dollar against the Turkish Lira, given that the Turkish Central Bank is expected to take their interest rate decision today. Even though they're expected to hike, I honestly do not believe it's going to have any material impact on the upward trajectory. As you can see, we had placed this back in the day, 27.212. That was prior resistance, clearly not valid anymore. Maintaining a bullish outlook, and it's actually forming a very nice upwards moving trend line, which you could also chart yourselves. Upwards moving trend line validated on numerous occasions. RSI still above 15 or 60, so small market correction perhaps. If they do hike, taking out some stops, moving higher. And now for support. For support, it's purely speculation, as you can see by this bearish candle. It's pretty, I'd say, difficult to accurately find support levels which may withstand any sudden moves. But for argument's sake, 28.50, big figure as well, seems to have found support on a few occasions, jumped, moved higher, that could be S1. Then for S2, 27.60. And as we've said before, could easily just look at this bearish candle. It could easily break below S2 as well. So we're placing some distance in between them. And then 26.73 for S3. And then for resistance, a 28.87, most recent high. And why is it the most recent high? It is an all-time high, and it continues to make all-time highs. Therefore, that would be resistance at R1. Then for R2, let's just measure the distance between S1 and S2. 938. 29.75. And then we could do 30.6. So S1, S2, S3, R1, R2, R3, highly volatile pair. If they hike more than expected, it may provide some support for the Turkish Lira, but it would have to be significant. Even if it's just 1% more, I do not expect it to actually provide support for the Turkish Lira. Maybe temporarily, and then continuing its upward trajectory. Dollar CAD, we're seeing, following BOC Governor Clem's slightly hawkish statements, implying that the bank may have to hike one more time. Moved lower yesterday, just barely in the reds today. Perhaps a small market correction. Support and resistance, you could say, remain the same, or we could slightly adjust R1. 1.375, 1.3760, just round it up. Keeping R2, R3. It's below 50, so there's a slight bearish market sentiment. If it breaks below S1, then we maintain a bearish outlook. If it fails to break below S1 today, sideways between S1 and R1. And let's just bring S2 slightly higher. Previous swing high, 1.3505. So that would be S2, and then you have S3, 1.3375. Maybe with downwards moving trend line. Perhaps fairly, time will tell for this downwards moving trend line. So just a pointer. For a bullish outlook, simply breaking above R1 and then aiming for R2. We're going to be looking at gold as well. Now, we've had support and resistance levels. We're keeping R1, R2, and R3 the same. As you can see, validated resistance 2005. Then for support, could be slightly higher. But even if we keep it at 1,975, 77 might be slightly better. It's moving in an upwards fashion, but our near 50 narrowing sideways between S1 and R1 from a technical and on a fundamental perspective. The easing tensions in the Middle East between the big powers appears to be reducing the upward trajectory of gold. Now, there's talks, well, they've agreed to a ceasefire, but it's not going to be implemented tomorrow. It appears that it may take a few more days, but it's alleviating fears of a wider escalation of regional tensions, perhaps other nations joining the war. So we may see gold moving in a downward trajectory. However, the longer it takes for the ceasefire to be implemented, then it actually might move in an upwards fashion, breaking above R1 and moving towards R2. From a technical point of view, between S1 and R1, for a bearish outlook, simply breaking below S1 would be sufficient, with the next target being S2. What else can we look at today? Dollar JPY bounced off S1, broke above support and resistance. Uh, 148 point. Let's keep it at 80. So this is S1. Keeping as prior S1 becomes now S2. And then we need to find our new R3. This becomes S2, and then prior S2 becomes S3. So we have R1. Let's keep R1. 150.30. But where would we place R3? We'll readjust. It found resistance here, so this could be a temporary resistance level. 149.60. So this is a more short-term view, not from a macro perspective for the next day. R2, strong downwards movement, 150.65. R3, 151.90. For a bullish outlook, breaking above R1 and R2, given that we're bringing R1 slightly lower. For a bullish outlook, it would simply not be breaking above R1. It would have to break above R2 as well, or at the very least, wick above R2. 150.65. Okay. 151.90 for R3, 149.60. R1, yes, R1 is 148.80, 147.35, 145.90. 50 RSI could be a small market correction before moving higher. I'd like to see it break above R1 before I have a bullish outlook on the pair. If it touches S1, moves higher, needs to break above R1 actually simply for a bullish outlook. If it does not, sideways between S1 and R1, given that it's 50, perhaps a neutral market sentiment, but time will tell as well. And lastly, let's look at the stock. We could see Alibaba, actually the Aussie against the US dollar. given that there's also a fundamental point of view. Broken below our upwards moving trend line, so sideways bias for the Aussie. So for the Aussie in particular, you may have seen that Bloomberg is reporting that the Chinese government may be instructing banks to provide loans to property developers for a long term and unrestricted as well. Now, in theory, that's boosting money into the economy, so it may improve China's growth. If China grows, then demand for oil could increase, which could push oil prices higher, and it could actually improve the Aussie. The Australian economy, so their export economy, is heavily reliant on China for their exports. So China imports Australian goods. So if the Chinese economy is growing in terms of manufacturing, they're demanding more Australian goods, and which means Australian dollar. So this may be positive news for the Aussie as well. The issue is, in my opinion, if you've reached the point where you have two property developers, Evergrande and Country Garden, who have defaulted and Country Garden missed their last coupon payment, if you're throwing money at the problem, how is that going to fix the underlying fundamental issues in your economy? Perhaps it may fix it, yes. Perhaps stimulating economic growth could potentially mitigate any loss. Yes, that is actually valid. But my own personal opinion is that it is very concerning that we've reached this point. I personally do believe that the Chinese economy may be facing some problems from a more macro perspective, as I've been saying for the past few months. So even if the Aussie does gain some support, which it appears to have been unchanged based on the news, from a more macro perspective, perhaps weaker Aussie and lower oil prices, should the Chinese economy should the concerns about the Chinese economy continue to increase. I do not think that is a more macro solution to provide unrestricted loans to already embattled property developers. And I think that may cause more issues down the line rather than supporting the Chinese economy. And let's actually do one more stock. One last one. We could do Alibaba, Facebook, Lockheed. Facebook moving upwards, Lockheed, of course, Goldman Sachs. Let's do Goldman Sachs. We had noted this point around Goldman Sachs' earnings. It filled this gap. Actually, support we're off slightly, so 332.57 for S1, and then prior support. So this is 2 S3, removing our old S3. R1, bearish candle, 342.30. Then we could bring R2, 357.48. And then R3, 372.40. So this is more from a more macro perspective. And with that, we're done for today. Thank you for watching, and until next time.
everyone. The term risk-off refers to the mood of traders and investors in the financial market when they want to avoid risk exposure and safeguard their funds. When traders are pessimistic about the economic outlook, they tend to sell risky assets and buy safe haven assets. In such an environment, safe haven assets like the Japanese yen and gold tend to gain in value, while high-risk assets like stocks and commodities tend to decline. Markets are frequently labeled as risk-on or risk-off. Both of them express global market sentiment. Risk-on, risk-off is frequently abbreviated as RORO. This happens when price behavior is driven by investors and traders' changes in their risk tolerance. When traders are not optimistic, then they tend to reduce leverage, selling risky assets and buying safer assets or even preferring cash. US Treasuries and German bonds are considered almost risk-free. The US dollar, Japanese yen, and the Swiss franc are safe havens and tend to rally when traders want safety during times of uncertainty. The price of gold usually increases and the yield on government bonds falls. Thank you so much for watching us today, guys. Stay tuned. Bye-bye.
Let's go ahead and get started. Okay, so I'm Melanie and I will be your speaker for today's webinar. So for today's session, we're talking about the second part of our Build Your Trading Strategy series. So today we're going to be focusing on day trading. Okay. Yeah, if you guys have any questions throughout the webinar, feel free to let me know in the chat. Yeah, I think that's about it. So before we get started, as per usual, a risk warning. So our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So a disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So as per usual, I'm Melanie and I'm your speaker for today. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. So I'm just going to show you guys what are the key news events to look out for, or how you can implement them into your strategy. So this is based off of last week's news events, but I will show you guys this week's news events as well. I'm just going to use last week's as an example. Then we'll reference higher time frames, see which time frame you should use for day trading, identify momentum, taking a trade, and we'll go through a couple of basic day trading techniques. Okay, so let me know in the chat how many of you guys like to use or like to day trade. And yeah, let's just go ahead and get started. So this was last week's events. Okay, maybe I'll just make my camera smaller. Okay. So this was last week's events. You can see we like to use forexfactory.com. So let me just pull out this week's events. So this just shows you the medium to high impact news events. This is just how we like to use an economic calendar by comparing the actual and forecasted data to determine the outlook of the news release. So if you take a look at my screen now, right, when you go into forexfactory.com, it will give you guys, I mean, it kind of looks like this. So it'll give you all of the different impacts events, as well as today's events. But let's say if I'm looking at this week's events, so 23rd to 27th, you can see I have all of the events, and I like to click this filter. So as I mentioned earlier, we like to just look at the medium and high impact events. But if you are particularly looking at a specific currency or different event types, you can go ahead and adjust those as well. Okay, and then you can take a look and see all of the different events that will take place this week. So it's quite a busy week this week with a lot of events taking place. Yeah, a lot of PMI releases. Okay, so let's just get back to our slides. So it's important to use an economic calendar when you day trade, because day trading in particular, it will affect your trades. Whenever a news release is out, you could see it go up or down. So it's important to take note of your fundamentals when you are day trading. Okay, next, let's move on. So now we are referencing the higher time frame. So what we mean by this, okay, let me just pull out my charts to show you guys. Okay, so let's say if I'm looking at the Aussie dollar, okay, and I'm looking at it on the 4-hour time frame. Okay, so let's say if I want to analyze this on the 4-hour time frame, I will go in with all of my trend lines, all of my the Fibonacci, so on and so forth. But I will also want to reference the higher time frames, such as the 1 day as well as the 1 week. Okay, so there's actually the reason for this is so that you can see what the general trend is, okay, even on the higher time frames, because sometimes it does differ from between the time frames. So it's important to take a note of the different time frames, especially the higher time frames. And there is a strategy, I don't know, can't remember right now who it's by, but it's like a factor of 4 or 6 or multiple of 4 or 6. In this case, since we are referencing higher time frames, the rule is that you will go up either by a multiple of 4 or by a multiple of 6. So 4 times 6 would be 24 hours. So then we will look at the daily time frame. And then the daily time frame times 6 is 6 days, but we don't have 6 days on TradingView. So closest will be 1 week. So that's why we look at the 1 week time frame. Okay, that's basically how it works. If you're looking at a smaller time frame, so for day trading, normally we look at higher time frames. But if you want to look at the lower time frames as well, it's the same concept. Instead of a multiple, you look at a factor of 4 or 6. Okay, I can't really remember who started this strategy, but it's quite a popular one to go by. Okay, so that's what we mean. So which time frame should you use for day trading? So before we get into that, okay, day trading, normally we use either the 1 hour, 4 hour, daily time frames, depending on your preference, and also depending on which time frame gives you a clearer market structure. So this is an example of a clear market structure. Okay. This is excuse me, this is an example of an unclear market structure. Okay, you can see the markets are really choppy, and you can't really see the shape of the chart very clearly. Okay, so obviously, if you are looking at which time frame is the most important, if we're looking at the same chart, okay, this is on the M15, and you can see that it's really unclear. Okay, and this is on the 1 hour view, which is clear. Okay, so what I'm trying to highlight here is that it really depends on which time frame gives you the clearest shape or chart. Okay, and this is really important for so when you look for swing highs, swing lows, this is really important for your support and resistance levels, which obviously is important for your entry, your stop loss, and take profit levels, but it's also important for your analysis. So your Fibonacci trend lines would have to follow the shape of your chart. So the clearer it is, the more effective your Fibonacci will be. There's also graphical tools. So like you saw over here, I have a really nice descending trend line with a very clear market structure. Okay, and this is also part of graphical analysis. So it shows you the trend really clearly as well. So at the very basics, the clearer the swing low or swing high, and the clearer the trend between these 2 points, the more accurate your analysis will be. So apart from having your own preference on which time frames you like to use as a day trader, it's also important to take note of which time frame gives you the clearest market structure. Okay, so far, are there any questions? Okay, if all good, let's move on. Okay, so here's just a brief intro into multiple time frame analysis, since we are briefly talking a bit about time frames. So the multi-time frame analysis. Okay, thanks, Ben. So the multi-time frame analysis is a trading strategy that involves analyzing the market from multiple time frames, like I mentioned earlier. So this, as a beginner trader or even as an expert trader, it basically helps you to get a better understanding of the market and make more informed trading decisions. So the first step in this strategy is to select the time frames to analyze. So typically, traders will choose at least 2 time frames. So there'll be a short-term time frame, so 15 minutes, and a longer time frame, which will be either 1 hour or daily. Okay, so the short-term time frame is used to identify the most recent trends and price movements, while the longer-term time frame is used to identify the overall trend and market direction. Okay, so I briefly went through all of these earlier when I showed you guys the chart. Okay, but yeah, so once the time frames are selected, you can then analyze the markets from each time frame. Look for key support and resistance levels, the different trends, as well as patterns. So for example, if the short-term trend is bullish and the longer-term trend is also bullish, this could indicate a strong uptrend in the market. Okay, so as a trader, you can use this information to make more informed trading decisions. So if the short-term trend is bearish, on the other hand, because in this case we're talking about bullish. So on the other hand, of course, if your short-term trend is bearish, longer-term trend is also bearish, of course, you can probably expect it to be a strong downtrend in the market. Okay, but if let's say the short-term trend is bullish and the long-term trend is bearish, then you can make use of your different indicators and graphical analysis tools to help you to forecast where markets are headed. So it's a little bit more complicated for those. Okay, so overall, multi-time frame analysis can help you as a trader gain a better understanding of the market and make more informed decisions by looking at the bigger picture and analyzing trends and patterns from the different time frames. Okay, so what should you look out for on higher time frames? Firstly, we have the key graphical levels. So these, we're talking about support, resistance levels. Next, we are talking about trend lines, trend channels, which obviously give you an idea of the trend. Next, breakouts. So by breakouts, we're talking about either breaking out the trend line, breaking out of trend channels, or different key graphical levels. Big moving averages. So if you make use of the 50, 100, 200 golden cross or death cross levels, the indicators, and Ichimoku cloud as well. So we can use the Ichimoku cloud to give us an idea of where prices are headed towards. So if price is moving below the Ichimoku cloud, it is a bearish signal. If price is moving above the Ichimoku cloud, then it's a bullish signal. Okay. Okay, so next we have big Fibonacci levels like retracements, extensions, and projections. And lastly, we have price action. So what we mean by price action is basically looking at past, present, future momentums from the previous bar to dictate your strategy. Okay, so let's take a look at how we can identify momentum. Okay, okay. So firstly, let's look at the different momentum indicators. So the first one we're going to be talking about is the MACD, or Moving Average Convergence Divergence indicator. So I personally really like to use this indicator because at one glance, it tells you exactly what the signals are. Okay, so if you want to know the calculation behind it, it's basically works by calculating by subtracting the 26 period exponential moving average, or EMA, from the 12 period EMA. So the signal line is a 9 period EMA of the MACD line. So MACD is best used for daily periods where the traditional settings of 26, 12, and 9 days is the norm. MACD triggers technical signals when the MACD line crosses above the sell line, the signal line, which would then signal that you can go for a buy, or falls below it, which is a signal for sell. Okay, so this uses three exponential moving averages to identify price movements. Difference between these averages is shown in a histogram. I'll show you guys in a little bit. And the movement can show whether a trend is strengthening or weakening. However, moving averages always lag behind price action, and they are more suitable for identifying entry points. So here is the points that I was talking about earlier. You can see the MACD line is the blue line, signal line is the orange line, and histogram is the red and green areas. And of course, the zero line is just over here. Okay. So the selling signal occurs when the MACD crosses over the signal line, or if you can see over here, it's also when our histogram is red. Okay, and yeah, so this is one of the trading strategies. So over here we have a buy entry. Okay, we're showing you the different buy entries that you can identify from the MACD. So you see price, or rather the signal line crossing over, and you also see this MACD histogram being green. So it's a huge bullish signal. And then once it crosses over again, it is a bullish signal here again. Crosses over, bullish signal, crosses over, bullish signal. You guys kind of get it. Okay, so every time there is a crossover, you can expect a change in trend. Okay, so if we look at the sell entry, same concept. Okay, it's just that when the signal line crosses over, then you see this red area. Similarly over here and here as well. Yeah, you guys kind of get it. Okay, but as I mentioned earlier, it is a lagging indicator like you see over here. So over here it says it's pretty green, you know, and it doesn't cross over until after this drop. Okay, so just be careful or just be aware of that if you are intending to use this. Okay, next let's move on to a couple more momentum indicators. So I also personally like to use these two. Okay, RSI, let's start with that. So how it works is it oscillates between 0 and 100, with values above 70 considered overbought, values below 30 considered oversold. When the RSI value is above 70, it suggests that the security may be overvalued due for a price correction, potentially indicating a sell signal. When the RSI value is below 30, it suggests that the security may be undervalued and due for price rebound, potentially indicating a buy signal. Okay, I guess I'll show you guys an example. Okay, there's an example in the next slide. Okay, so stochastic oscillator readings more than 80 indicate that price is near its high. Readings below 20 indicate that prices are near the lows. A security is overbought when the percentage K line moves below above 80 and is oversold when the K line moves below 20. So this is an example here. In this case, we like to use hidden support and resistance levels. So for both of these indicators, in this example, we use stochastic, but you can also use this method for RSI as well. So for this method, you see that on our stochastic or RSI indicator, we have a hidden resistance level. Basically, all of the peaks are at the same level here. But you can see that on our price chart, price is making a higher high. Over here as well, a higher high. Okay, so what this basically means is that we can expect price to drop immediately after this, which is exactly what happened here. So once you identify these and these, once you identify price making a higher high on the second peak, whereas on our stochastic or RSI, it's giving us the same peak or the same level, then you can expect price to immediately drop after that. Similarly for over here. And in this example, we're also using stochastic, but here we are using a hidden support level. So you can see we have this really nice support level on our stochastic. But you can see on our price chart, price is near lower low. And over here, we have an ascending trend line. Whereas, of course, over here, we don't. So this suggests that we can expect price to continue to drop or continue to rise from the buy entry, or rather from our ascending trend line to the take profit. Okay, and you can see that's exactly what happened here. Okay. Okay, so if we look at bearish divergence on the other hand, here we have price, is this? Okay, so you see a descending, it's quite subtle, but you can see price is making lower highs on our RSI, whereas on our price chart, it's making, it's still a resistance level. Okay, so price is testing a key horizontal resistance level with price making a smaller high, resulting in bearish divergence with RSI. So bearish divergence, basically when it's RSI or stochastic, you see price making a descending trend line. Whereas on our price chart, it's kind of staying at the same level. That's basically what bearish divergence means. Okay, so our descending resistance line on RSI caught the past two reversals correctly over here. So you see there's two drops here. So we can expect that the third one, we would be seeing another reversal over here. Okay. Next, yeah, so this is just the example from here. You can see that price reverses strongly because of the horizontal resistance here, as well as the RSI resistance and bearish divergence. Okay, another example here, but this one is just on a smaller scale. So you can see that even if the difference in price is pretty small, it can also work. So for stochastic, it's giving us a lower high, and on the price chart, it's making a higher high. Okay, so yeah, so we can expect price to continue to drop. Okay, so you see the repeated pattern here, bearish divergence here and here. You see price drop here immediately after that. Okay, so it rises, and we see this price making a higher high once again, but on our stochastic, it's making a lower high. So we can expect price to continue to drop, or rather not continue to drop, but you can expect price to reverse from this point. Okay, and that's exactly what I did here. Hey, so divergence potential. So over here, we see price making a higher high, and on our RSI, price is making a lower high. So same thing, this is another example of a bearish divergence. First point, we want to always take note of where the bearish divergence started, as this is the level where it would tend to reverse to. Bearish divergence means price is making higher highs, RSI is making lower highs. Okay, so we can expect price to drop down here. And because this is a so if you were here for the support and resistance webinars, you would know that this is called a overlap overlap support. Basically, it's just when price respects the bulls and bears of this level here. So we basically have swing highs and swing lows that are touching the same level. That's just what an overlap level is. So then you can expect price to come back down and reverse off of it again, or react off of it. So you see here, it's a overlap support because we have swing highs and swing lows. You can see price did reverse off of it. Okay, forecasting breakouts. So we have this ascending trend line on our price chart, but we also have this ascending trend line on our RSI. But at this point, at this first column, RSI broke out of the ascending support line before price did. So this forecast that price might actually break out of it after this level here, which is exactly what happened here. Price broke. This is basically a predictor that price is likely to break out of this ascending trend line. Okay. So here as well, in this case, we have an ascending trend line or descending trend line, but we are expecting price to break out of it and head upwards. So price is moving downwards here. This is actually not a valid trend line because you guys will know that a valid trend line requires 3 significant touches, whereas here we only have 2. But on our RSI, we do have 3, and that's why we're pointing it out. Okay, so we have 3 points making a valid trend line, and price RSI is breaking out of this descending trend line. Okay, so from here, price is breaking out of it, so we're expecting it to continue to rise. We're expecting this price to continue to rise and break out of this ascending trend line. Now we see over here that there is also bullish divergence. Bullish divergence is basically the opposite of bearish divergence. So on our price chart, price is making a lower low, and on our RSI, it's making a higher low. Okay, so first point, price is now testing the descending resistance line, which is basically a descending trend line, and we're wondering if it will break out of it. But we see RSI descending line breakout over here right before this. And number 3, the recent bullish divergence further suggests that we could be seeing a strong reversal or breakout of this descending trend line. Okay. So we have a successful breakout of the descending resistance line as forecasted by our RSI. Okay, any questions? Okay, that's great. Let's continue. So lastly, is this our last part? Okay, I'm not sure if this is our last part. But okay, next we are taking the trade. So firstly, if we look at the different news events, so bringing us back to our first point where I mentioned that when you're day trading, it's really important to look at your fundamentals and take a look at your economic calendars. So in this example, we are using the US unemployment claims, which occur 12:30 p.m. GMT every Thursday. We also have the central bank interest rate decisions. Okay, so in this example, on the 15th of June, we had the unemployment claims, which was over here. You can see Thursday, 15th June at 12 o'clock, we can see this drop over here. Okay, because of the unemployment claims data. Okay, and this is on our DXY. So we see this drop. If we recap, go back to what we talked about for the MACD, you can see price cross over here, right? The signal line and the MACD line, price crossed over. And then we also see this red histogram, the red area. So very bullish signals, and you see price drop at that timing. But if we look at gold, you see here XAUUSD, this is gold. And you can see that on the other hand, on the same day, at the same time, gold actually shot up. Okay, you can see if we're looking at our MACD, price signal line cross over the MACD line. Okay, and also it's giving us a green histogram area. So very bullish signals, and you see price shoot up at the same time. Okay, so this is just because gold tends to be negatively correlated to the DXY. Tends to be, not always, but yeah. So that's why it's important to keep up with your fundamentals and take a look at these as well. So if maybe I'll just sidetrack a little bit and show you guys this correlation table from my FX book. Okay, so you can type in, so I think normally we use 80%. So if it's on negative 80. So currencies with correlation lower than 80% and higher than 80%. Okay, we're day trading, so I'll just use 1 day. Okay, I can't remember if it's 80 or 70%. If you guys know, let me know in the comments in the chat. But yeah, so it highlights those that are really strongly negatively correlated or positively correlated so that you can check them on your charts. So if you can see one that is really strongly, maybe like this 90%, the Euro AUD as well as the AUD franc are pretty strongly negatively correlated. So you can expect when price goes up on one, the other will go down. Okay, yeah, it's just a bit of a sidetrack for you guys to take note. Or if you guys are curious. Okay, let's get back to our slides. Okay, so another example here is the FOMC meetings. So just now, I think I mentioned we're talking about central bank minutes. So central bank minutes for FOMC meetings often come with your interest rate increases, interest rate hikes, or even if they stay the same, those tend to be released during FOMC meetings. So you can see on the 14th of June at 6 p.m., at that time, you can see MACD line and signal line crossing over each other and giving us a bullish signal. You can see price also shot up. Okay. Oh, yes, this is the DXY. So because I mentioned earlier that they tend to be negatively correlated, you can expect price to drop down for our gold at the same time. Okay. And you can see here that it is a little bit laggy because the drop really happened a little bit earlier, but our MACD was only able to catch it a bit later. So just take note of that if you intend to use the MACD. But otherwise, you can see that it's pretty useful in helping you to catch any changes in trends, which tend to be quite frequent because the market is pretty volatile during news releases and during events, which is why it's important to keep up with your fundamentals or look at your economic calendar. Okay. Again, another example, 12th of October, we have the unemployment claims. Once again, can see price shoot up at 12:30 p.m. for our DXY. So you can probably expect it to drop as well on our Euro-US for our gold. But in this case, we are talking about Euro-USD, and price is dropping as well. Okay. Basic day trading techniques. Okay, so we kind of went through a few of these already. Okay, but yeah, we'll just talk about them a little bit. So basic day trading techniques, we have the first one, which is following the trend. So anyone who follows the trend will buy when prices are rising or short sell when they drop, which is normally what we recommend, to just follow the trend. And that's why it's important to look at the different time frames as well. But this is done on the assumption that prices that have been rising or falling steadily will continue to do so. Contrarian investing. This strategy assumes a rise in prices will reverse and drop. The contrarian buys during a fall or short sells during a rise with the express expectation that the trend will change. So you can see why we typically recommend the first technique. Okay, trading the news. We also highly recommend trading the news because investors using this strategy will buy when good news is announced or short sell when there's bad news. And this is really closely linked to investor sentiment as well, which of course can affect the market's volatility as well, but can also lead to higher profits or higher losses. Okay, that's all for our slides, but we still have a little bit of time. So let me know in the chat if there are any charts that you guys would like me to go through. I think we maybe have time for one or two. Maybe we will just take a look at gold first. Okay, and then if you guys have any requests, just let me know in the chat. Okay, so if I'm day trading on the 4-hour time frame, right, I would look at the 1 hour time frame maybe. I mentioned earlier the higher time frames I would look at would be the 4-hour and daily time frames, okay? Because factor of 4, factor of 6, or multiple, sorry. Okay, so let's take a look at our daily time frame. Okay, on our daily time frame, we have this multiple swing high here. Okay, we also have this ascending trend line. And you can see prices are pretty bullish over here on our daily time frame. Now on our 4-hour time frame, you can also see prices are really bullish. Okay. But there is a resistance level here. Okay. That price is currently testing. Now our 1-hour time frame. So this is where I'm gonna go in and do our analysis. Okay, so I'm just gonna place my first support here. Second support here. First resistance. Second resistance here. Okay, second support here. So these are just purely graphical. And then now I'll go in with some Fibonacci levels to support my graphical levels. Okay, and I can see my 22.6 lines up with my second support. Okay. Okay, I'm looking for a retracement. So for retracement, we use these 5 levels. Okay, and I can see my 50% lines up with my first resistance. Okay, my 78.6 also lines up with my second resistance. Wait. Okay, my second resistance is a pretty significant level. Okay, you can see I can pull it all the way back. Okay, I'm just gonna highlight this area here. Okay. Okay, now I'm gonna go in with some indicators. So I like to use Ichimoku and MACD because at first glance it tells you exactly what the signals are. So MACD you can, or rather Ichimoku, you can see price moving below the cloud. Okay, let me see if I can zoom it in. Yeah. So you can see price moving below the cloud, and on our MACD, can kind of see price moving below, or rather price crossing over already as well. Okay, so overall bearish for both of these signals. So I can go in for a sell from my first resistance to my first support. But I'm gonna go in just to double check. I'm gonna go in with another indicator as well. Okay. So it's really important to have a bunch of indicators that you're really comfortable using because there are so many indicators out there. So a bunch will tell you that it's bearish, and then the other half will tell you that it's bullish. So as long as you know how to use a few indicators, and then you just test them whenever you are done with your analysis, your graphical and your Fibonacci analysis, that would be enough. Okay, so I can see my RSI, I have a descending trend line as well. So very bearish over here. So I'm going in for sell from my first resistance to my first support. Okay. Okay, we have a request for US oil. So I'll just go ahead and do that now. Okay. Let's see on the 4-hour or 1-hour time frame, which of these gives us a clearer graph, clearer chart. Okay, I think the 4-hour gives us a clearer chart. Yeah, let's go ahead and do that. So starting with our weekly time frame. Okay, trend is pretty bullish. Okay, except for this reversal here. Daily also, is this a trend line? Okay, no trend line, but also pretty bullish. Okay, in just the trend, but if we just look at the trend alone. Okay, but here is pretty bearish. Okay, let's see if we have any trend lines. Okay, we do. We have this ascending trend line. Okay, but it's currently testing this trend line. So we'll go ahead and take a look at that in a bit. This is my first support. And my second support, maybe this here. Here. Okay, and then my first resistance and my second resistance just here. Okay, now let's go in with our Fibonacci levels again. Okay, I have this 61.8 that lines up with my second resistance. And my 61.8 also lines up nicely. Okay, now I'm looking for another retracement, and I can see my 60. Okay, my 50% lines up with my first resistance. And okay, my 61.8 also lines up with my second resistance. Okay, now let's go ahead and look at some indicators. So same thing. Price is moving below the Ichimoku cloud, so it's giving us a bearish signal. MACD is also giving us a bearish signal. Let's see RSI. Okay, RSI isn't really telling us much. Let's look at stochastic. Okay, stochastic, you guys can see this hidden resistance that we talked about earlier. Okay, and we see that price has made a lower low here. Okay, so this means that we can continue to expect price to continue to drop. Okay. Okay, maybe we can look at another indicator. We see price crossing over each other. Okay, price is moving below the EMA and SMA, so it's a bearish signal. I thought we could see a trend difference if there is a crossover, but the trend difference has already occurred. Okay, so overall, all of our signals are pretty bearish despite this ascending trend line. Okay, so we can expect it to continue to drop or to break out of this ascending trend line. I'll remove that so it's not so messy. So drop and continue to drop towards our second support. Okay, but I want to mention that we might see price reacting off of this level. at our first support because we have a confluence area here with the swing lows, and also with the 61.8 and the 100% Fibonacci projections. Okay, so we might see price reacting off of our first support. But overall, there's still a lot of downward pressure. So we can probably expect it to break out the first support and head towards our second support. Okay, and that's it. Yeah, let me know if you guys have any questions. If not, that's all the time we have for today. Thank you guys so much and have a great rest of your week. And I'll see you guys next week. Bye everyone. Bye, Yuria. Thanks for coming. See you next week.